If you were to walk down any street in America or Britain today and ask the average person why they are struggling financially, they will point to the same few things. They will point to inflation. They will point to the housing market. They will point to interest rates. And they are not entirely wrong. Those are real macroeconomic forces that are acting as a brutal headwind against the working class in 2026. But they are missing the silent, invisible thief that is actually doing the most damage to their daily wealth. It is a thief that they voluntarily invite into their homes, carry in their pockets, and interact with dozens of times a day. That thief is convenience. We are currently living through what I call the convenience collapse. Over the last decade, the entire consumer economy has been ruthlessly optimized by some of the smartest engineers and psychologists on the planet for one singular purpose: to remove every single ounce of friction between your desires and your wallet. They have made it so incredibly easy to spend money that you no longer even feel the psychological weight of the transaction. You click a button, you tap a piece of glass, you look at a sensor, and the money is gone. This sounds like a technological triumph. In reality, it is a financial tragedy. When I was building my wealth in the early days, getting to that first $100,000 felt impossible. Every dollar was a struggle. But there was a physical friction to spending money. You had to go to a bank, withdraw paper bills, physically hand them to another human being, and watch your stack of cash physically deplete. That friction was a natural defense mechanism. It gave your rational brain a moment to pause and ask, do I really need this? Today, that defense mechanism has been entirely dismantled. The gap between impulse and purchase has been reduced to milliseconds. And because of this, the middle class is bleeding capital at a rate that is mathematically unsustainable. You are being financially bled to death by 1,000 tiny, convenient cuts. Today, I am going to break down the 5 distinct convenience traps that are defining the 2026 economy. These are the specific, normalized behaviors that are ensuring the middle class remains permanently broke, regardless of how high their salaries go. I am going to show you exactly how the financial system has weaponized your own desire for an easy life against you. And then I'm going to give you the blueprint for the anti-convenience portfolio. The exact steps you must take to rebuild the walls around your capital and redirect that money into the compounding machines that will actually buy your freedom. This will require discipline. It will require you to intentionally make your own life slightly more difficult in the short term. But the reward for that short-term difficulty is long-term absolute sovereignty over your own existence. Let us look at the first trap that is destroying the modern balance sheet. The first trap is the normalization of microdebt for daily consumption. Historically, debt was a tool used for massive, life-altering purchases. You went into debt to buy a house. Perhaps you went into debt to buy a necessary vehicle or to fund an education. Today, the financial industry has successfully normalized going into debt for a pizza, for a pair of sneakers, and for a weekend trip. The explosion of buy now, pay later schemes has created an entire generation of people who believe that if they can afford the first installment, they can afford the item. This is the architecture of permanent poverty. These products are designed by very smart people to extract maximum money from your pocket while making you feel like you're getting a good deal. The average credit card interest rate in America right now is over 20%. In the UK, it's between 18 and 25%. Let me put that in perspective. The stock market has historically returned around 10% annually over the long term. If you're paying 20% on debt while investing at 10% returns, you're losing money. When you finance a depreciating consumer good, you are taking your future labor, the hours you have not even worked yet, and you are volunteering to give them to a financial institution plus a massive premium. You are mortgaging your future to finance a fleeting moment of convenience in the present. You cannot out-invest high-interest debt. Don't even try. The wealthiest people I know view consumer debt with absolute visceral disgust. They pay for their consumption in cash, and they use debt exclusively to acquire productive, cash-flowing assets. If you are financing your lifestyle in 2026, you are not a consumer. You are the product being consumed by the banks. The second trap is the outsource epidemic. We have become a society that treats our own time as if it is too valuable for basic human maintenance, yet we sell that same time to our employers for a fraction of its worth. We pay massive premiums to have our groceries picked out and delivered to our door. We pay massive premiums to have our meals cooked and driven to our houses. We pay companies to walk our dogs, assemble our furniture, and clean our homes. The rationale is always the same. I am paying for convenience because my time is valuable. If you are a CEO making $5,000 an hour, perhaps outsourcing your grocery shopping is a mathematically sound decision. But for the average person earning a middle-class wage, outsourcing your basic survival tasks is a catastrophic drain on your free cash flow. You are paying a 30 to 50% premium on your daily life simply to avoid an hour of chores. The money you are spending on the convenience premium is the exact money you need to be using to build your wealth. If you save just $200 a month by cooking your own food and picking up your own groceries and invest that money, the mathematics of compounding will perform miracles over the next 3 decades. Every time you pay someone else to do something you are perfectly capable of doing yourself, you are robbing your future self of financial independence. The wealthy are often incredibly frugal with their daily operations. They widen the gap between earning and spending relentlessly. They know that the dollars saved on convenience are the soldiers that will fight for them in the financial markets. The third trap is the algorithmic lifestyle. In 2026, you are not making your own purchasing decisions. You believe you are, but you are not. The algorithms that power your social media feeds, your search engines, and your entertainment platforms know more about your psychological vulnerabilities than you do. They know when you are stressed, they know when you are insecure, and they know exactly what product to put in front of your eyes at the exact moment your willpower is at its lowest. You click, you buy, and the dopamine hits. But the dopamine fades by the next morning, leaving you with less capital and the exact same baseline level of exhaustion. This is a cycle of engineered dissatisfaction. The economy requires you to be permanently unhappy with what you have so that you will continue to consume. To break this trap, you must become a hostile witness to your own consumption. You must forcefully disconnect your emotions from your spending. When you feel the urge to buy something that was algorithmically placed in front of you, you must implement a mandatory 48-hour waiting period. Force the friction back into the system. You will find that 90% of the things you believed were absolute necessities on Tuesday are completely forgotten by Thursday. The fourth trap is the subscription death by 1,000 cuts. Corporate America learned a very valuable lesson in the last 20 years. If they charge you $1,000 up front for a product, you will hesitate, you will budget, you will analyze the purchase. But if they charge you $15 a month, forever, you will ignore it. You are drowning in invisible payments: software, entertainment, music, premium deliveries, fitness apps, cloud storage. These companies rely on the laziness tax. They know that the psychological friction required to log in, navigate a customer service menu, and cancel a subscription is higher than the pain of losing $15 a month. But you must do the math. $15 a month here, $20 a month there, $30 a month over there. Suddenly you are bleeding hundreds of dollars a month in purely phantom expenses. The average American household earning 6 figures often has less than $20,000 saved. They earn substantial incomes and spend almost all of it. They're rich in income, poor in wealth. You must conduct a ruthless quarterly audit of your bank statements. If a subscription is not actively making you healthier, significantly smarter, or directly contributing to your income, you must sever it. You are renting your existence. The wealthy do not rent, they own. Every subscription you cancel is a permanent raise you have just given yourself, tax-free. The fifth and final trap is the illusion of the deserved upgrade.
Society has conditioned us to believe that as our income grows, our lifestyle must immediately grow to match it. You get a promotion, so you trade in your perfectly functional car for a newer, more expensive model. You pay off your student loans, so you immediately take out a massive mortgage on a larger house. This is the trap of lifestyle creep, and it is the reason why people making $250,000 a year can still be living paycheck to paycheck. They believe they have earned the upgrade. I still live in the same house I bought in 1958 for $31,500. I could afford any mansion in the world, private islands, fleets of cars, but I don't want those things. The money I didn't spend on mansions got invested and compounded for decades. Every dollar you spend is a dollar that can't work for you. When you upgrade your lifestyle to match your income, you are maintaining a gap of zero. The gap is the mathematical distance between what you earn and what you spend. If you increase your spending every time you increase your earning, you are a hamster on a wheel that is simply spinning faster. You must divorce your standard of living from your income. When you get a raise, your lifestyle should freeze, and 100% of that new capital should be deployed into productive assets. This brings us to the ultimate solution. How do you escape the convenience collapse? You must build the anti-convenience portfolio. You must transition from being a passive consumer of convenience to an active accumulator of capital. Here is the exact 4-step protocol you must execute. Step 1. Reintroduce the friction. You must intentionally make it difficult for yourself to spend money. Delete the saved credit card information from your web browsers. Delete the shopping apps from your smartphone. If you want to buy something, force yourself to physically get up, find your wallet, and type in the 16-digit number. That small window of physical friction is often enough to break the algorithmic trance and allow your rational brain to intervene. Step 2. Automate the offense. While you must introduce friction to your spending, you must remove absolutely all friction from your investing. Human beings are terrible at making consistent financial decisions. We're emotional, we're easily influenced. The solution is automation. Set up automatic transfers from your checking account to your investment accounts on the day after you receive income. Choose your investment allocations once based on principles, not predictions, and then automate the purchases. If the money goes straight to investments before it reaches your spending account, you'll adjust your lifestyle to whatever remains. Step 3. Acquire the monopolies of convenience. This is the ultimate mental pivot. Instead of being the victim of the convenience economy, you must become its owner. The companies that are charging the subscription fees, the companies that are processing the microtransactions, the companies that are building the algorithms, these are highly profitable enterprises. You do not need to start a competing business, you simply need to buy their equity. For most people, the simplest way to own productive assets is through low-cost index funds that track broad market indices, an S&P 500 fund, a total stock market fund, or a global equity fund. Keep it simple. When you own the index, you own the infrastructure of the modern economy. When the rest of the world is paying convenience fees, those fees are flowing upward into the corporate earnings that drive the value of your portfolio. You transition from the one paying the toll to the one owning the toll bridge. Step 4. The liquidity moat. Finally, you must insulate yourself from the desperation that forces people into bad debt. In every personal crisis, cash provides survival time. Job losses, health emergencies, unexpected obligations, these require immediate liquidity that investment accounts can't always provide quickly. I recommend maintaining at least 6 months of essential expenses in highly liquid form, not invested, not tied up in assets that could take months to sell, available immediately. This isn't money you're investing, it's insurance, it's buying power for emergencies and opportunities. It's what allows you to stay calm when everyone else is panicking. The economy of 2026 is an incredibly dangerous place for the undisciplined. It is a machine designed to extract wealth from those who seek the path of least resistance. But for those who are willing to embrace a little bit of difficulty, those who are willing to cook their own meals, drive older cars, read 5 to 6 hours daily, say no to the algorithmic temptations, and relentlessly automate their investments, it is an era of unprecedented opportunity. Wealth is not built through one dramatic, heroic decision. It is built through thousands of tiny, boring, highly disciplined choices repeated day after day, year after year. It is built by rejecting the convenience collapse and demanding absolute sovereignty over your own capital. The path is right in front of you. It is entirely up to you whether you will walk it.